Tom Lee, this was actually from last night. Tom Lee talking about the market's going to go down quite a bit more, basically after this month. So we'll get into that. Appreciate everybody joining me as always. Want to get straight into this. If you're looking to apply, join my private group, get access to all my course curriculums, access to the 6- and 7-figure Discord chat, all that good stuff. Check out the pinned comment down there. Tom Lee on the volatile markets and what he's expecting here.
And I should have said that because you think the first part of this year, despite being bullish for the whole year, could be a little bit skimpy in terms of return.
Yes, Brian. I think we've got to digest that huge move you talked about.
Where's Tom Lee and what have you done with him? You were Mr. Bull last year. You were right on the mark about everything, and now you're a little more cautious.
Yeah, maybe it's because I skimped on the appetizers.
That's it. That's later.
Yes. Yeah, I'm still optimistic for the year. But, in the first half, and we got a glimpse of that today with Fed governors talking about not sure how many cuts they want to do. That's going to make markets nervous. And we got a pretty lousy Empire survey reading today, a regional PMI, and that's going to get people worried about a soft landing or hard landing. Those don't get answered for the next 6 months. So I think it's possible that we make a minor new high before the end of the month, and then we might have something like a 7% drawdown.
The Fed governor you're referring to is a gentleman named Christopher Waller, very smart guy, but he's not Jerome Powell. He is not the chair of the Federal Reserve. With all due respect to Mr. Waller, why is Wall Street suddenly paying so much attention to these one or two couple comments?
It's a fair question. We know for the last 2 years the Fed's been fighting inflation. So we know what that kind of regime and playbook is. Now we're moving to a playbook of, well, inflation is slowing. The Fed wants to keep real rates from getting too high, but we don't know what kind of cuts and when those happen. That's the nervousness we're going to have over the next 6 months.
I don't like to place too much credence in 1 month of data, particularly among some of these sort of smaller or more regional Fed surveys or surveys of this or surveys of that. You referenced one, though. This is the Empire Manufacturing Survey, folks.
And real quick here, something super important is, generally speaking, everybody's so excited about rate cuts. I've said this several times on this channel now. Usually when you're getting rate cuts, it's not good for the market. Everybody thinks like, oh, rate cuts, this is going to be great for the market. It's actually usually not good for the market. It actually means the market could actually go lower. And many times they're cutting and they keep cutting because, let's just say, the economy's getting worse. So I'm not super excited for when they do actually start cutting rates, just to be honest. Well, maybe my hedges are excited about that, but for my long positions, I'm not. Because then you really need everything to stay perfect in the economy to actually get the market to continue to roll. And a lot of times it's not realistic. They're cutting because things are continuing to deteriorate in the actual economy.
If you don't know what we're talking about, don't worry. 95% of you probably don't. It is a manufacturing survey around New York State. And usually it gets completely ignored by Wall Street. Nobody cares, except this data point, correct me if I'm wrong, Tom, came in so awful that even people who didn't care about this Empire survey suddenly started to care.
Yeah, it was pretty atrocious.
It was still awful, but you think it's just one noisy data piece?
There's a lot of things that can make it noisy. We know supply chains are being rerouted right now, and we know markets have been tumultuous. And, we've seen that during weeks of market corrections, regional surveys often tank because the purchasing manager might just say things are worse, but it's because the stock market's down. So it's really hard to know how much is signal versus other things contributing to it.
But I want to be optimistic today, and you do remain bullish. 5,200, correct?
Yes.
On the S&P is your price target for the year. That is not changing.
Yeah, I think investors who are long-term oriented should really just ignore the first 6 months. We have a Fed that's going to be shifting from being really tight to accommodative. Earnings are recovering.
Don't ignore the first 6 months. Take advantage of some deals out there, because if we get what Tom Lee's talking about here in the S&P 500, a 7% drawdown in the S&P 500, you got to understand that means probably a 10% plus drawdown in the NASDAQ, if he's correct on that, right? Which means countless stocks down between 10% and 25%. If he's accurate, which he might be, he might not be, but that's just something to keep in mind. So, make sure you take advantage of some deals out there if you do get presented with that opportunity, especially in big tech, because big tech, we haven't gotten crap for good deals in big tech since really 2022. So that's the real space. Like, if you get some opportunities there, take advantage.
got interest rates coming down. That's great news for consumers. And I think businesses in general have a CapEx cycle ahead. So, I mean, the stock market should do well this year. It's just, it doesn't mean it's...
CapEx cycle, the problem with that is that means company spending, which could hurt profitability of some companies. Just keep that in mind.
Well, that's about a 9% gain from where we are now. If you are also correct in that the market tumbles a little bit in the next couple of months, you know, we all know it takes a bigger gain to get back to where you were after a drop because of something called math. So it's going to take maybe a 15% jump from the trough to get to that 5,200.
Yes, Brian, that's right. I think there's a chance at some point this year, maybe it's June, you have a chance to make 20% between now and year end. And I think small caps could make a bigger move, you know, 50 or 60%. So I think there's still... Yeah, I think the IWM could end the year, Russell 2000 could end above 3,000.
Now,
okay, he just took it to another level. Man is now talking about 50 to 60% for small caps this year. I mean, my gosh, I'm waiting on that. Tom Lee, I hope you're correct. If there's ever one prediction I really, really hope you're correct on, oh my gosh, I hope you're correct on that one. Oh man, that would be beautiful. Let's go ahead and get into the dean of valuation and if he thinks this market's overvalued, and then I'll explain why I think the market's overvalued or undervalued right now.
Simple question. Is it a simple answer?
I think right now the market is overvalued. I mean, my estimate is about 9-10%. And part of the reason, I think, is the expectations game has turned against the market. I mean, if you remember at the start of last year, recession was almost guaranteed, rates were going to go up, inflation was out of control. And every strategist that you had essentially said was going to be a terrible year for stocks. Turned out to be the exact opposite. Everything turned out to work in the opposite direction. My fear is that we've moved too much in the other direction. Now people assume there's no recession. Inflation is under control.
To push back against him right there, not everybody said 2023 was going to be a bad year. What I think the consensus was, based upon what I heard, and, you know, having this reaction channel, listen to all these Wall Streeters all the time, what the consensus was going into last year, into 2023, was we were going to have a really bad first half of the year, and then the second half of the year was going to be better. That was the overall consensus. I can tell you what I felt out there and what I heard out there. Obviously, the first half of the year was booming, caught a lot of people off guard, right? And then a lot of those people that wanted to buy in the back half of the year because they thought it was going to be a good year, they kind of got forced into the market. And I think that's what actually happened in the market. And those fund managers and a lot of those folks started to underperform the indexes quite considerably, and they had to play catch up into year end, which is exactly what I said would happen, and that's exactly what happened. That's why October, you know, if you look in mid-October through about the end of December, I mean, it was just boom times for the market. Everything was flying because, let's just call it what it is. Like, you know, people were all caught off guard and they had to play catch up. It could happen again this year, by the way. It could. You know, we know there's a lot of people that are kind of, you know, still very skeptical on this market. We already see some of these big dog companies running really quickly here, the NVIDIAs and the AMDs and the Metas and some of these stocks. So we'll see how this shakes out, but you never know. It could be a replay of last year. I'm not expecting that. I'm expecting still some big sell-offs in a lot of even those stocks. Obviously, we're already seeing some sell-off in the Russell, considerably already this year, and some of the small caps. But I think we still will get a pullback this quarter in a lot of these big dog stocks. That's coming here in a bit. You just got to be patient on that.
And everything's going to be okay. So I think this year, good news is going to require a lot more than it did last year. And that, to me, is why I think stocks are in a dangerous place right now.
Well, what if, in fact, inflation is coming down at a pretty good clip? And what if the economy is holding up pretty well? Then that would obviously throw the equation into a different answer.
That's already priced in. And I think that's the problem, is we're pricing in the good stuff. And I think the worry now is there might be surprises. In fact, there will be surprises. You go back to 2008, every single year, we've had some big surprise that nobody saw coming. And I'm sure there will be it's an election year. I can't see this year going by without significant big surprises. So to me, that's the danger you face investing in stocks right now.
What about the prior guest?
And that's why I said I think this could be a much more volatile year than 23. 23 was pretty chill. Other than SVB happened there, and that got volatility up for just a bit, and then it died right down. I think this year could definitely be more volatile. We got a lot more things at play this year. And so I think you're going to see some much bigger quick moves to the upside and downside in this market. And so it's going to shake some people around. It's going to shake some people out of the market this year. The real players will stay around. They'll buy those dips and they'll take advantage of those deals because you could get 10 to 20% corrections very quickly, 5% corrections very quickly. They'll shake some people out. And ultimately, those will be huge buy the dip opportunities that will present themselves.
Just spoke with who suggested, certainly one of them, that staples, REITs, utilities, all these unloved places of a year ago are cheap on a valuation standpoint. How do you view those?
Well, part of the reason they're cheap is they didn't have a recovery last year. If you look at what stocks did last year, even though overall stocks were up 26%, lots of sectors actually had single digit, and utilities and real estate and energy were actually down last year. And if you take utilities, which had a bad year the previous year as well, it's been 2 bad years in a row. So in a sense, they're better priced. And as a defensive investment, I think they're okay, but they're not going to make you 20% returns this year. That's not going to happen.
Maybe some people would be that, you know what, that's just fine. I mean, I don't necessarily look for 20% return. I just want some, a relatively good return. Is there an area of the market, Professor, you look at and say is particularly attractive because it is cheap enough?
I think utilities would be the place I go for that reason. I think that energy is always up and down. Energy had a great year the previous year. It gave back some of those winnings. I mean, utilities have been surprisingly down over the last 2 years because, last year you can't blame interest rates. The T1 rate actually ended the year at exactly the same level that it started the year. So from an interest rate perspective, it should have been a good year, but it did not have it. So maybe it's overdue. And that's, I think, one reason I would look at utilities going forward.
Yeah, utilities, if you're really bearish on the market, utilities are a good play. It's usually a relatively good preservation of capital, let's just call it that. Do I feel the stock market's overvalued or not? And the answer to that is I don't feel the stock market's overvalued. I also don't feel like we're in an undervalued market right now. I feel like we're pretty fairly valued. I think if you look at mega cap, I think we're on the upper ranges of valuation. I think if you look at small cap, we're on the lower valuation ranges. But that's nothing new. We've actually been here for a bit now at this point in time. At some point, that's not going to stay like that. I can tell you that. At some point, smalls are going to really come back. And I say really come back, I'm talking about for real. And I don't know about the 50% upside like the Tom Lee's expecting, but I'm talking about like the Russell rolls like a 25 to 30% gain in like a 12-month span. I'm talking about that sort of real comeback in small cap stocks. So that's just kind of a waiting game in terms of that. And that, will eventually play out that way. So that's where I'm at valuation-wise on this market. You can look at Yardini Research. He's always got a lot of great numbers and metrics to look at, kind of broken down by sectors, broken down by different stocks and things like that, okay? S&P 500 price objective can hit 6,100. We're in the S&P 500, 4,000. What we have, 4,700, 4,800, 6,100. Oh, my God.
Managing partner. She's also a CNBC
That's
contributor.
Mind-blowing.
Look back at the previous year and try to look ahead. That's just natural because of where we are on the calendar. People are talking about Apple losing some momentum. That could be important for the overall market because it's such a leader. Is this something more than just a backing and filling period for Apple?
Well, I think we have to contextualize it, right? We had such a huge move from the major indices ahead of this pullback. It was more pronounced for Apple than for most of the mega caps and also for the major indices. And yet, to me, we now have a short-term oversold reading for Apple. It's still within the context of a long-term uptrend. There's good support right around 179, 180. So it's a bit of a proving ground for it. I'm not ready to add exposure yet, but just with a little stabilization, I would say I'd feel actually confident adding into weakness. And that's often hard to do. People talk about, well, buy the dip. Well, here's the dip, and it has people a bit shaken.
I hesitate to ask you about, for a technician, you do talk about election years, so you don't need to talk about it in a fundamental way. You can just talk about it statistically, what happens during election years, but also what about sentiment? That no one expected the type of gains that we saw, I think, in 2023. Could it repeat itself in 2024, and is that likely in an election year?
So the thing about Q4 was that we saw this major breakout, and it was a breakout that was shared not just by the large cap indices, but also the small cap indices. So we saw big breadth on this big move, resistance levels cleared, and that does set a very positive tone for the year, for the whole year, in fact, because we have what technicians call these big cup and handle formations. If you look at a chart long-term of Microsoft as one example, Microsoft being a big heavyweight, just like Apple, of course, we have this major breakout to new all-time highs, and that clears the chart of resistance. It shows a sentiment shift and also a willingness now to go farther down the market cap spectrum. So I think that that's going to be key for the market, and also the spreading out in terms of sector participation. We had technology, communications, all the mega cap heavy sectors did best, even with the Q4 rally. But now we're seeing financials as one example kick in, and maybe even healthcare.
I mean, it was a hated rally, and it gave the bears hope that they were going to end up being right about October lows. Now we got to specify which October we're talking about. But, for 2 straight years, people were married to the October lows and retesting those. And for most of 2023, people were either not in love with the rally or thought there was going to be a comeuppance, so
True.
it wasn't going to continue. Was that all taken care of in the fourth quarter? It was solidly.
I would say so. And
yeah.
Even earlier in the year when we had a breakout back in May, that to me is where we emerged from that bear cycle of 2022. And we had to sort of concede to the fact that even though leadership was narrow, we had this bull market cycle in place. We can arrive at, for the S&P 500, a price objective of about 6,100 if we see new highs. And we are looking for new highs after this consolidation. And we're really not reading too much into the consolidation because it does follow such a strong relief rally. And with that, of course, you get the overbought reading in market sentiment, in market breadth.
We did have a guy, it was just a couple weeks ago, Becky, 3,500. Still talking about 3,500 on the SP. Did you just say 6,100?
6,100. And that wouldn't necessarily be relevant for this year, but it's something to sort of remind you to keep a bullish bias when the markets are trending higher. The long-term momentum shift is really very meaningful, what we saw last year. It took kind of a long time to unfold based on the nature of the 2022 bear market cycle. But now we have these long-term momentum gauges pointing higher, and overbought conditions so far are being absorbed very well, and that's characteristic of a bull market.
All right, next time you're on, we can talk interest rates. Is there a way, how do you look at inflation? Do you do charts for inflation?
We don't often chart the macro data in that way. It's a little slow moving for us,
bonds
for my
to chart
taste.
inflation. You could use
but certainly
the 10-year.
yields. I mean, we think yields will be in a corrective mode, meaning sideways to lower for much of this year.
The yields, not the bond.
Interesting.
Based on the nature of the 2022.
I mean, at the end of the day, how do we get to 6,100? Whoo, baby. Apple's got to get back to nice revenue growth. When I say nice revenue growth, I'm talking like 5-10%. Microsoft's got to come through with their numbers. They should be good. NVIDIA's got to keep posting great numbers, as they have been. Meta and Amazon kind of come in and smash it again in 24, just like they did in 23. Google's got to get some footing there. You know, Tesla's got to start to come back in the back half of the year. So you're going to need a lot to go right in order to even try to approach a 6,100. And I mean, a lot to go right. And then you also need to avoid recession. That's the other big thing. If you can get all that, then maybe 6,100 is possible at the end of this year or, you know, at some point in 25. But you're going to need a lot to go right to get us there. Let's be very clear about that, okay? Appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel, each and every one of you. First video I put out in a long time on this channel, so I appreciate you guys still showing up. And also, pin comment down there if you're looking to apply, join my private group and get access to all my course curriculums, get access to my private Discord chat with the 6- and 7-figure members, all that good stuff. Pin comment. Much love and have a great day.